Last weekend, OPEC Plus agreed to boost production by 411,000 barrels a day for the third month in a row, continuing their plan to roll back voluntary production cuts. After years of limiting output to support prices, key members are now ramping up supply, pushing oil prices to a 4-year low. With changing economic pressures, some oil exporting countries are having to find new ways to counter a decline in oil revenue, and refining margins could be one of them. I'm Johanna Bota, and joining me today to break it all down is StoneX's Director of Market Strategy, Alex Hodes. Welcome, Alex. Let's start with Saudi Arabia, one of the top OPEC producers who has been ramping up refinery operations, not only to take advantage of stronger margins, but also to offset falling crude oil revenues. How effective is using refining margins as a hedge?
Thank you, Joanna. It really has been effective at kind of being able to sustain some of these lower pricing levels, while Saudi Arabia themselves as kind of the model, they actually have quite low production costs. So even while prices are at a lower level, Saudi Arabia doesn't really have the high price level like some other producers like the US. So there's a little bit of leeway there, but on the other end, it's kind of used as a balance for their financial situation. So either they rein in some spending or they increase their revenue on the oil side. So another way to kind of diversify that financial strategy has been to invest in the downstream sector. So overall, as a whole, the Middle East has expanded several refineries and they've also increased kind of their petrochemical footprint as well. So just recently, they expanded their PDH plants, which is a way to convert propane into plastics resin. So there's really a diversification there. It's been effective, but still, the main driver of the economy is oil. So their management of the oil situation is paramount to kind of their financial situation as well.
Of course. And what's the current state of the U.S. refining sector? And what insights did the latest earnings report reveal?
So some U.S. refiners, companies specifically, Valero underperformed at the last earnings release, but some of the others were kind of steady. However, it's kind of looking with reference to the previous years, and we were coming off record high refining levels. So although refining margins have kind of come down, they're still about historical levels. Several refineries in the US have taken back and started to reduce some of their refining inputs. Some refineries in Houston, as well as Los Angeles, have started to close. And that's more to do with kind of a diversification away from that refining sector, specifically in California, with kind of the amplified regulations. There's a little bit more scrutiny there. So it's kind of more just a symptom of that rather than the refining margin environment itself. They have kind of dipped down, but that's the cycle of the commodity build out. There's been a substantial build out of refining capacity over the past several years. So we had those record high margins in 22 and early 23, but have really come down on the back of expanding refining capacity and lowered oil demand globally.
I see. And as I mentioned at the beginning of the conversation, OPEC Plus members have decided to increase production by 411,000 barrels per day for the third straight month. What do you make of this decision?
So I think there's been several months of some producers within the group that have really continued to overproduce. So instead of continuing with those low level of quotas, they have really increased these to kind of accommodate for that overproduction because if they don't really have the word of the market of if they say that production is going to be here and production keeps coming in with countries like Kazakhstan and Iraq consistently overproducing, really it doesn't give as much confidence in the group's decision, and thus the group itself loses some of its grip on the control of the market. So them increasing this production capacity is actually more of a way to kind of rein in the group and uh, kind of have some unity among the group. And as of the last data, there was only really an increase of 17,000 barrels per day from April to May in terms of actual production hitting the market. So really, although it on the surface it sounds like a lot of extra supply is coming online, a lot of that has been accounted for with kind of the overproduction that has gone on over the past several months. So it's more of a way to kind of manage the market.
I see. Well, thank you, Alex. And thank you for watching. For more financial content like this, don't forget to like and subscribe to our channel.